Sandi, welcome back. You just heard Dom's piece. I mean, people have been foregoing yield because they don't care. It's like, I just want growth. I'm not really caring about the payout. Where do you come in on the hunt for yield?
I think we're hunters like Dom is, Brian. When we look at portfolios, we're thinking about our clients who are corporate executives, family business owners, and entrepreneurs. So these are people using their portfolios to achieve their goals over time, and they tend to have very long investment time horizons going out decades. So we're focused on longer term. So it's not just the next month, the next quarter, the next year. We're looking out at the next 7 years. And as we see things, there's still a lot of uncertainty. But where we've liked to keep our yields in the bond portfolios, that yield is disappearing with the interest rates being at zero and continuing to be that way for the next few years. So we're worried about negative real returns after inflation. And we're starting to move some of the money in our portfolios out of fixed income and into some of the value stocks that Dom was mentioning, because they are offering great dividend yields. The stock prices are low, so there's a lot of appreciation. There's some really great companies in there that should tend to do well. Dom talked about the financials. Yeah. We're looking at consumer product companies, healthcare, so United Health Group, Procter & Gamble, Johnson & Johnson, companies like that we think are going to be the place to be. And so as we see the market, if we see the market continue to go down, we'll start to peel more and more of our fixed income into those types of stocks.
And all the corporate executives watch CNBC, Sandi, as you know, and the CFO or CEO of P&G or J&J may be watching right now, and if they do, they should mute their televisions, because I'm going to say something that's going to tick them off. Have those companies, and there's your chance, mute now, have those companies become annuities in a way? The J&J, a great company, by the way, and we're rooting for them on the vaccine, but the idea is, they basically become de facto bonds in a way.
Well, not de facto bonds. I mean, there's still some risk there, but there's a huge amount of growth, right? You don't see so much growth in bonds. So we don't look at them as annuities at all. We look at them as a long-term play to really help boost the portfolio overall. And by moving out of bonds and into these types of stocks and grabbing the dividend, which is still taxed at favorable tax rates for our clients, we think that's just the way to go.
Yeah, you look at a company like a J&J and a P&G, and by the way, we're not picking on those companies. They're great companies. We're simply saying that the idea that whatever their dividend payout is, combine that with a little bit of growth, and there's almost no reason to own U.S. debt, particularly when you're going to have a debt to GDP ratio that is not only sky high, Sandi, but the highest it's been ever on record, even higher than the peak of World War II.
That's right. And that has us very concerned in general. So from that perspective, Brian, we agree with you. Moving more into stocks away from bonds should provide greater diversification, greater growth over time. But we really do need the economy to come back. We need to get over the hump of this pandemic. We think we still have a couple years left to get out of the hole. But stocks like these should perform well as we look out over the next 7 years. And we're excited about that.
Yeah, and what happens to bonds, Sandi? Because, here's the thing about interest rates. And yesterday we heard from 700 Fed members, which is just ridiculous. I want to hear from them once a quarter and then go away. Anyway, that's my own opinion. If you look at the amount of debt we're going to have, a 1% change in the Fed funds rate will destroy the bond market with this level of debt. So you look at that and you think, and I hate using terms like forever and never because they're always wrong. How about this? Rates have got to stay low for a long, long time. Otherwise, we're going to bankrupt the United States. How about that?
We expect them to stay low for a long time. That's for sure. But certainly, things can change. Interest rates can shift faster than we think for unknown reasons to us today. And so we do like the idea of being diversified, Brian. Having some bonds in the portfolio, we think will always make good sense. Because we're dealing with individual clients, we prefer munis over treasuries in general. But a lot of people love their treasuries. They're hugging them. They just feel that's the safest place to be. We think it's time to move out of bonds and into stocks some more. And we're going at a gradual pace. We're not jumping in.
It's Friday. Not like that matters anymore, Sandi, but we always like to get some opportunity on a Friday, leave on a positive note very quickly. Give us one more stock idea that you love right now.
PayPal is a stock that we like. It has a very high PE, which isn't necessarily aligned with the way we think about investments, but we think it's a solid company. They're out front in terms of digital payments and e-commerce. We've seen a huge spike in that with the stay-at-home provisions. We don't see that changing as we move forward. And PayPal has been working with merchants to bring cryptocurrencies onto the platform, which we think will be a good thing in the long term as well. So.